Okay, I see the numbers are climbing nicely. Good morning, everybody. I hope you're all well. Thank you for joining the CFO South Africa webinar in partnership with Nedbank CIB. Today, we're going to be hearing all about the webinar, which is Supply Chain Finance to the Rescue, a COVID-19 survival guide for corporates and their suppliers. If you don't mind, if you can all have a look in the chat, if you could let us know who you are, your title and your designation, that'll be awesome. I'll give you a few seconds to do that before I introduce our guests. Okay, the numbers are still climbing, which is great. So we'll give them a few seconds to continue joining. In the meantime, I would like to introduce you to our guest speakers. So if I can ask you both to come on camera. Perfect, fantastic. So I'd like to introduce you to Mike Brandon and Lloyd Caughey. Mike will be chatting about the local impact on supply chains, and Lloyd will be highlighting the impact around international business. Mike and Lloyd have both been with Nedbank CIB for many, many years. And Mike is the head customized trade solutions, and Lloyd is the head of sales global business unit. To kick things off, we're going to go straight into a poll. So if everybody could keep a look on the left-hand side, you're going to see a poll come up. And if you please would click on and submit your selection. So here we go. Okay, we'll give you a couple of seconds to have a look and to type in your selection. Okay, I see the graphs moving nicely. Mike and Lloyd, can you see the poll?
I can't yet. Let me push poll.
Yeah.
Yes, I can. Yeah, thank you.
Perfect.
Great.
Okay, I think we'll give it a 2 or 3 seconds, and then we can end the poll. Perfect. I'm going to go ahead and end this poll. So you can see there that there's pretty much majority of our audience is made up of SMMEs, and in second place we've got large corporates, followed by mid-sized corporates, and then government entity. So thank you to the audience for adding your info in there. We're going to run a second poll. If you could tell us a little bit more about the business you represent. So do you buy and or sell domestically only? Do you buy and sell or buy and or sell domestically and internationally? Do you provide services locally or do you provide services internationally? So here we go. Okay, local is lacquer, definitely seems to be leading this poll. Yeah, perfect. I'm going to end this poll. So it definitely looks like the majority provides services locally, which is fantastic. Great. Thank you, everybody. Appreciate your input. I think from here on in, we're going to hand over to Mike and gain Mike's insight. So Lloyd and I will go off camera and we'll hand over to you, Mike. Thank you.
Thank you, Tamara. And good morning, members and participants on the webinar. As introduced, Mike Brandon from Nedbank Customized Trade Solutions. It's my privilege to talk to you this morning around supply chain finance and unpack a couple of the realities that we face in South Africa at the moment in terms of supply chains and position perhaps a couple of ideas around solutions that would help us to navigate these difficult times that we find ourselves in as a result of a number of factors. I'll touch very quickly on the ones I think we're all very familiar with. We're in the middle of a lockdown. The lockdowns had a dramatic impact on the level of trading in the economy, which has placed supply chains under unprecedented pressure. And I think will continue to do so, at least in the short term, overlaid across global events that are rapidly shaping a change in the traditional trade flows in terms of trade globally. What does that mean for South Africa? What are the opportunities that represents? What are the risks that represents? And I think just looking at the polls, it's nice to see that we've got a good representation from the SMME sector and also the corporate sector, which means that what I'm going to talk about will hopefully be of relevance to both. And also in terms of where you trade, taking note of the fact that there's a good blend of domestic and international trade represented on the webinar. So I hope this will be useful and provide you with some good insight. Just stemming from where we find ourselves in the economy at the moment and what I've said around pressure on supply chains. The immediate question is, well, what does that mean? What does that pressure manifest in? And I think one of the key things that it manifests in is that people are trying desperately to optimize their working capital in the best way possible to maximize their cash flow so that their businesses can weather the storms that are going on around us. And more banks are being very mindful of the impact of these forces on the economy, are coming up with new and innovative ways to help companies to achieve the objective of having enough liquidity in their business ecosystems to be able to operate. But remember, we all work in an ecosystem. So what we do on one hand in terms of optimizing our own cash flow will have an impact on our suppliers, and how we extend terms to our debtors in the market will have an impact on how competitive we are. And it's a very difficult blend and balance to get right. What I will introduce to you is some discussion around supply chain financing. And supply chain financing is a set of techniques that we use in banking, leveraging off of typically fintech platforms to help buyers and suppliers in the market to benefit from their relative market strength, to optimize their working capital in a win-win way. And I look forward to taking you through in some detail how that works later on in the discussion. But what I'd like to do now is to hand over to Lloyd, who's going to give a perspective from the international trade side as we bring these themes together in our presentation to you all. Lloyd, I'll hand over to you.
Lloyd, I think you might be on mute.
Now on?
Now we can hear you.
Good morning. Thanks for the opportunity to chat to you. Following on with what Mike was talking about, on the international side, with the beginning of COVID, we've really gone through a really torrid time over the last 4 months. And if ever there was a black swan event, it's what we've all faced now. And I think the important things to always remember is if you set your business up right before the black swan event, it does make it a lot easier to go through it. And I'd like to just show 1 or 2 slides to give you an idea of the trends that we've seen over the last 4 months, and hopefully how you can avoid those type of pitfalls going forward. Tomorrow, if you could put my first slide on, please. So, sorry, it's not a great picture. We don't need to go into a lot of detail on it, but I think what you'll see is around the end of April, beginning of May, at one stage, we had a rand dollar rate that went to 18.80. And if you are an importer and you had done your budgets on the 13s, 14s that we were running with before that, you suddenly find yourself having to pay up to 20-25% more for the same goods. And if you have to sell them at the old price, it means you're going to take a loss. At the same time, you're going to find that your import duties and everything are linked to the exchange rate on the day that the goods come through customs or that your documents go through customs. So all those are inflated by the same amount. And either you've reduced your profit or you've actually gone into a loss on your import. So, and then we can see the trend comes down and then it's up and down again. And this just shows you whenever we're in a market where fear overrides the fundamentals, it takes a considerable time for it to come back to normal rates, and we're not there yet, and we're not sure when it will. And obviously, we had the double whammy of a Moody's downgrade and the COVID-19 lockdown together, so it has amplified it. And then, let's say you are an importer, and suddenly you're forced to pay dollars out on in the beginning of May, and to do that, you're going to use a dollar funding mechanism until you've got your goods cleared and you're able to sell them and you get paid. Let's have a look at the interest rates on dollars during the same period. So if you can go to the next slide, please. So when you look at that, we have exactly the same thing happening. This is the South African government cost of funds in dollars over the same period. And as you can see, we were running at, the 200, 250 basis points prior to the Moody's downgrade and the COVID pandemic. And at the height, we were over 600 or 6%. So that's a significant move in a short time. Now, if the government bonds move like that, the rest of the market moves in South Africa in a similar fashion. And, we saw where we were looking at a cost of funds in South Africa for the general banks of, a LIBOR plus 0.5%, a LIBOR plus 7%, that was the average cost of funds for a bank. At some stages during the initial panic of the first few weeks, you were talking cost of funds of LIBOR plus 200, 220 paid by the South African banks just because of liquidity. And what happened was the foreign banks all took a risk-off approach on South Africa, and that then had these rates move like this. So, if you were uncovered and were going to take out your trade loan only on the day you needed it with no kind of hedging in place, you could end up paying 18.80 and 4, 5, 6% on dollar rates for 2-3 months. And unless you have 150% markup, that means you're probably not going to be making money on that deal, and you will probably lose a significant amount. Then, on top of that, what we did see a lot of is foreign suppliers that were previously maybe working on open account, even with larger corporates, suddenly said, sorry, we either have to reduce your terms from 90 days to 30 days, or we want sight, or we want cash advance, or you have to give me an LC. And, we scrambled in the first few weeks to help a lot of corporates to issue the right instruments to help them so that their liquidity isn't severely impacted. Because there were two things that everyone's been looking at over the last 4 months. And the first one is, how do I make sure I get paid? I don't want to take any risk on that side. Secondly, how do I delay my payments out because I want to keep as much liquidity as I can? So, where Mike's area on the SAF side is highly domestic trade finance in effect, which we call supply chain finance, on our side, we do the international trade finance, and what we're trying to do there is try and allow our clients to pay as late as possible. And if they have an inward payment, we're trying to help them pay as quickly, to get paid as quickly as possible. And we have a number of instruments that I'll go into in the next slot in the session on how we can help clients do that. Anything else? I think from my side, that is what I wanted to mention though is one of the things we also saw is the cost of confirmation of South African banks. You know, in the past, prior to the downgrade in COVID, if we were issuing an outward LC, which we call an import LC for our clients, and getting confirmed in Europe, we would find that the cost per annum of confirming a South African bank would be, 25, 30, 40 basis points. The offshore banks were happy to take 3, 4, 5-year risk on South African banks. During the first month of the lockdown, we found some banks were quoting 2% per annum on South African bank risk. And we were finding that we couldn't go past 1 year, and most preferred to be at 6 months. Now, luckily, all that is also coming back to normality because we have a very strong banking system in South Africa. But all these things add costs to the importer's business and a lot of stress in the system when you're finding that limits are already constrained. So thank you. I'll hand over to Mike now. Sorry, Tamara. I think there's another poll.
Thank you. So yes, we've got some more polls coming up, and it's really a quick yes/no poll. So if you have a look on the right-hand side, let's have a look quickly. Perfect. So the first poll is, I have experienced a failure of a material supplier in the past 6 months that has led to business interruption. Have you or have you not experienced this? Wow. Okay, moving. Okay, so I'm going to end the poll on this one. No, it's still moving quite aggressively, so I'll give it a second or two. Okay, let's end this poll. So it seems like it's almost an even split, with the majority sitting at no on 55% and yes 44%. Next, yes or no. I have a contingency plan in place to mitigate the risk of supplier failure on my ability to continue trading over the next 12 months. Okay, polls are still moving. Okay, I'm going to end this poll. Results on this one are 37% say yes and 62% say no. Not great. Okay, next poll. Again, another yes, no. I have been requested by suppliers for early settlement of outstanding invoices. Give it another second or two. Okay, I'm going to end this poll. So 54% of you have said yes and 45% of you have said no. Quite an interesting result. I thought it would have been a little bit more different. And the last poll. I have seen an impact from the current volatility in exchange rates on my costing and margins. slow movement on this one. I'm going to end the poll now. So 88% of you have said yes, you've seen an impact from the current volatility, and 12% of you have said no. So very interesting polls there. Thank you for your participation. If I can invite Mike to join us again.
Tomorrow, thanks. I think those poll results are very, very interesting, and I think they're reflective of the need for a webinar like this. You know, if you haven't had a supplier at risk in terms of potential failure and the impact that could have on your supply chain yet, I hazard a guess that you're very likely to face that type of challenge in the foreseeable future. And I think also that having a contingency plan in place doesn't necessarily mean, you know, looking for a different supplier. I think, especially from the corporate lens, and we've got a unique perspective on this because we speak to senior leaders in finance at major JSE companies across all sectors of the South African economy. And what has become very clear to us is that there is a real and genuine desire by corporate South Africa to look after the health of its supply chain. And I think, you know, given some of the factors around the volatility as Lloyd described, and I mean, you know, the poll on the impact of the exchange rate volatility on pricing and costing is particularly relevant. You know, these forces are acting on our companies. What they're doing is they're making it very difficult to price our own goods and services competitively. They're making it very difficult to know who to sell to and what terms to offer to our debtors. They're making it very difficult to know what terms we desire from our suppliers and to what extent we wish to extend our own days payable and what impact will that have on the supplier. So to frame the context of the options that we have to manage these different forces, I'm going to talk around two key working capital levers: days sales outstanding and days payable outstanding, and the solution sets that we use to help our companies to mitigate the impact of term extension on their businesses, that impact on liquidity, and also what that does to the health of suppliers. All right. So if we take a scenario common to any business, I need to compete with a number of other companies in order to market my own goods and services. So what do? I go to the market and I say, look, I'm prepared to offer you extended payment terms. And what does that do? That absorbs cash in my business, right? So what can I do to still continue offering terms to the market, but make sure that my business has sufficient liquidity to offer those terms in the first place? And there's a number of options available to you to consider. The one that we most see a demand for in CIB is what we call selective invoice discounting. And what selective invoice discounting does is you have a prime name debtor that you offer terms to, where you have a significant amount of working capital tied up in providing those terms. You come along to the bank, we have a look at the debtor, we do an assessment of the debtor, and what we are often willing to do is to purchase that invoice from you, which means that you can convert that debtor to cash on your balance sheet, and we take the risk on the debtor paying down the line. So this is an option that on the days sales outstanding side provides some measure of liquidity relief to your business on qualifying debtor invoices. On the other side of the equation, we also offer supply chain finance. I'm going to spend a little bit of time unpacking supply chain finance for you. It's a mechanism that's become more and more common in South Africa. It started here in around 2015. And it's really got to the stage where almost every single corporate we're talking to has either heard about supply chain finance or is on supply chain finance. And what supply chain finance does is that it allows you to avail of extended payment terms from your suppliers without impacting on your supplier's liquidity. So let me explain what that means. Your supplier provides us goods and services as he does in the normal course of business. And in the normal course of business, you will approve that invoice and you'll mark it as good for payment. That invoice is then made available to the supplier, typically on a digital platform, to elect to receive early settlement, right? Once they elect to do that, that payment instruction comes through to the bank. The bank will settle your supplier on approval of the invoice, and we will acquire the right to repayment under the receivable from the supplier. So we become your trade creditor. Again, subject to audit approval, this is also an off-balance sheet solution. And on maturity of the invoice, you would simply settle the bank. Now, how does this help your supplier? How does this help your supplier to build resilience in their business? The most important win for the supplier under a solution like this is that the discount for that paper is benchmarked to your risk as a corporate. So good news for the SME people participating in the webinar today is that whereas now, if you have a corporate who's a debtor, you've got to find a way to finance terms to that debtor. If your corporate customer is on supply chain finance and they're willing to onboard you onto the program, it means that you can access funding at the rate that the corporate qualifies for, which is typically a rate that would help you as a supplier to a corporate to use your balance sheet to grow your own business, because now you're not having to avail necessarily of an overdraft. You've got another financing mechanism that means that you can trap liquidity in your business. And why is this good for corporate buyers? This is good for corporate buyers because you're helping your suppliers to grow. And when your suppliers can grow, they can improve the quality of the goods and services that they render to your business. They can employ more people. In the South African context, we know we're facing a jobs crisis. It's absolutely critical that we do all we can to incubate SMMEs so that they can become larger players in the economy. It stimulates the economy, and it's something that we all need to do. And a lot of the corporates that we speak to, this is a key focus area for them. It is not lip service. They are trying very hard to support their suppliers. So this is a wonderful mechanism to enable an outcome that's actually very good for society as well. For the corporate as well, you've now extended your days payable. So if we're able to reduce days sales outstanding and we're able to increase days payable outstanding, our cash conversion cycles are moving to neutral to positive territory, which means that we then are able to trap liquidity in the business and use that to optimize our borrowing profiles. We're able to use that to invest in our businesses. So these two levers together, supported by selective invoice discounting on one hand and supply chain finance on the other hand, coming together are good for any business, whether you're an SMME, whether you're a large corporate. Those are the two levers that you're concentrating on to make sure that you can compete effectively in what is probably the most difficult market that most people have seen. So one of the questions that we often asked as well is, well, you know, how do I manage this? What should I be? What conversation should I be having with my suppliers at the moment? How do I test and assess the strength of my suppliers? Because remember, if your suppliers cannot perform, it can have a knock-on effect on your business. As we saw in the poll tomorrow, a number of companies have already had this happen. A key supplier has ceased trading, which means if you're in manufacturing and there's an essential component that was supplied by a specialized business and it's not there anymore, there's a serious problem. And what type of contingency plan should you have in place to engage with your suppliers to gauge their health? Now, one of the warning signs, and the reason why we had the question on the poll is, if you have a supplier who's just provided an invoice to you and he phones the next day and he says, please, I need you to pay this invoice, and he's prepared to offer a settlement discount out of the norm, what he's telling you is that he has a problem. Because that cash desperation means that he desperately needs to get liquidity into his business to keep going. So what does it take to kind of prevent that from happening? And it boils down to communication with your supplier base. How often are you meeting with your suppliers? How often are you testing to see that they are able to cope with the terms that they've extended to you? And I'm talking to the corporates here. Have you considered supply chain finance as a viable option to release liquidity at a very good cost of funds to your suppliers while improving your own business? And all of these factors coming together are going to become more and more relevant as this pandemic and its consequences unfold over the short to medium term. And what we're going to speak to as well now, is in terms of international trade, what are the different variations on the supply chain finance theme that can be used on documentary trade in terms of import flows, where, as Lloyd mentioned, we're in a global context where, amongst all the other challenges we have, the country's also been downgraded. At what point do foreign suppliers also start to put pressure on terms that they've previously granted, or start insisting on letters of credit? And what are the ways that supply chain financing techniques that we apply domestically, as I've spoken about now, can also be extrapolated into international trade, so that you can use those levers as well in terms of your international operations? So with that, I'd like to hand back to Lloyd to speak to supply chain finance in the context of global trade. And then we do look forward to your questions after we've presented around what we've discussed so far. Thanks, Lloyd.
Thank you, Mike. Tomorrow I can be heard this time.
Loud and clear, Lloyd.
Great, thank you. Thank you, Mike. So I think, when we look at the international side, so your local supply chain finance is a brilliant product, and in many ways you are dealing with people you really know. The minute you start looking internationally, and let's say you are buying, and I'm going to use an example to make it easier for me to explain. Let's say I import motor vehicles from China as an example. And, I've been dealing with the supplier of these motor vehicles for many years. And they've given me open account terms of, 100 days, 120 days, probably more realistically 90 days from bill of lading date. That means that, pre-COVID, I was importing the vehicles, and it takes maybe 2-3 weeks by ship to get the vehicles here. By the time I get those vehicles, I have to clear them. I then have to get them into dealerships and need to get them sold. And I should have the cash in my bank account, between 70 and 100, 110 days. And at that point, I would have already had to pay, or I'm just about ready to pay the Chinese supplier. Now, COVID hits. Moody's downgrade happens, and the Chinese supplier looks and says, Lloyd's business in South Africa has been good for us over the last few years, but I don't really know them. I'm worried about the South African country risk. You know what, guys, if you want to buy from us now, you need to give me the cash up front. Or alternatively, and we then say, well, we want a letter of credit. Now, unfortunately, I don't know the level of understanding of all the people on the call, but just a quick overview. So basically, a letter of credit is an obligation by Nedbank to pay the supplier. So as Lloyd's business here importing motor vehicles from China, I would have a facility with Nedbank. I would go to them and say, please, on my behalf, issue a letter of credit saying I will pay the Chinese supplier 90 days from bill of lading and when shipment happens. That way, I don't now need to pay out the cash. So I use up what we call an unfunded limit within the bank, but I pay no interest and I still have my same terms, and there's a bit of a cost on the LC. For the Chinese exporter, he looks at it and goes, great, I'm still happy to do the 90 days because, you know, I'm going to present documents against this LC, and actually I can wait 90 days, or even my Chinese bank may give me the funds up front, and we call that a discount. And that way, both buyer and supplier, the buyer gets his 90 days, the supplier gets paid immediately. He pays a bit of interest, but you know, the interest is normally better than an overdraft rate. Now, I think one of the important principles always to look at is whenever we do this type of funding, it is different to your normal overdraft funding in that your overdraft funding is done on balance sheet, we call it. In other words, we use your limits, and in your financial statements, if you're a corporate or if you're a listed company, it will show as debt. When we do use LCs and other products of that nature, we call them off-balance sheet type funding. And what it does is when we use this funding, it doesn't show on the client's balance sheet as debt. It shows as a future payable, and that is important. Also, it's very important that we only do this funding post-delivery. We take no performance risk. So we can't use an LC before the documents have been presented. So if I'm the Chinese exporter, the LC is generally worthless to me until I've given the shipping documents to the bank and they've said all the documents conform. So one of the products I wanted to highlight is we have two. So Mike went through SCF, and that's supply chain finance, and that's where a local buyer actually gives the ability to his suppliers to get funded. We've created a similar product in the international side, which we call SCF Plus, where in the example where I'm buying from the Chinese manufacturer and I'm doing it on open account, if he's not happy, I could also say, look, we can do SCF Plus, where Nedbank will confirm that we have a certain facility available, and when he presents documents, we will pay him on an open account basis. The next one is the letter of credit. And then the last one that I wanted to go through is, well, there's actually two more. We have something called UPAS. Now, UPAS is really an LC, but it stands for Usance LC Paid at Site. And what that is for is when I, as an importer, go off to the seller or exporter in China, there's a 30-day price, there's a 60-day price, there's a 90-day price. In other words, if I'm going to buy a motor vehicle, let's say, you know, an ABC car 1, the price for that car will depend on when I'm going to pay them, because they build the interest into the period. So, and they build the interest plus contingency costs in. So if I go to a Chinese supplier and say, give me the 90-day price, he's not going to just take his actual cost. He's going to add in a bit of extra fat just to make sure he doesn't get caught short. So we developed the UPAS LC as a way to say, look, Chinese supplier, I'm going to give you a site LC, okay? But from me as the importer side, the bank will give me 90, 120, 80, 180 days to pay the LC. And it has all the same implications. It's off balance sheet for me. It shows as a contingent liability in my balance sheet that I have a future payable due, but it doesn't show as overdraft. And the offshore Chinese supplier gets paid. And it gets a little more complicated, but just overall, that is what we've done. And that is, again, to preserve cash flow for our clients. And if you use the motor industry as an example, you can imagine 30% down in sales. They're sitting with stock. They have to still import new stock. They don't want to have more debt on their balance sheet than necessary. So we've used this to great use in the motor industry, where our clients then have the ability to create a usance period for themselves so that they can clear that stock, get paid, and then pay the bank. And then there's one more, which a lot of people, it's a very old product, it's been around for hundreds of years, and it's called a foreign bill for collection. Now, we call it FBCI and FBCO. And a foreign bill for collection, the I means inward, and when it's coming inward, it means from a South African point of view, it's an import for us, and an FBCO is an export for us. If I use the China's example again, you know, and this is also a real example. I can't use client names and examples, but this is something we did. We had a client where they were doing Factoring Chain International, were actually providing the offshore seller with funding on all their sales to the South African entity that we deal with. With COVID and all this, they've said, sorry, you know, our pricing has to go up, and actually we have to reduce our risk. So our local importer now suddenly is facing higher costs and a shorter period to pay. And we've put something in place for them, which we call an stabilization facility. And what we will now do is that the foreign supplier will send their documents on a foreign bill for collection, which is all your shipping documents together with a covering note. They will give them to their local bank in China or Asia or wherever it is, and they will send that to Nedbank. At Nedbank, we will go to our client and say, here are the documents, do you accept them? They accept those documents, and Nedbank then guarantees them, and we let the foreign bank know that they have a guaranteed payment in 90 days, and if they want, we'll even discount that payment for them, and which means is that we will actually give them the funds now, immediately, and we'll wait for our client to pay us in 90 days. So those are just some of the examples that I wanted to go through. It is a complicated field, but it's important to be aware that there are more than just overdrafts that you can use to fund your working capital, and that in the trade finance field, this is what we do. We work on how do we help you receive your funds quicker and how to delay your outward payments. And on the receipts side, if you receive an export letter of credit and it's confirmed by Nedbank, in other words, we're happy with the bank risk that of the issuing bank of that LC. If you present clean documents to us, we can discount that LC for you and give you cash immediately, and you don't even need to have bank facilities for that because we take risk on the foreign bank. Yeah, I think from our side that probably is what I just wanted to raise. And I know it's very high level, but it can get a little bit more complicated. Okay, thank you.
Thank you so much, Lloyd. Mike, feel free to come back on camera because we've reached our Q&A stage, and I see a couple of questions have been raised. But before we get to the audience's question, we had a few questions that came in during the registration process. So, Mike, I think this one is aimed at you. It's been raised by Richard Osborne from Penta Systems, and Richard's a great friend of the CFO community. So Richard's question is, what is the best time period to delay payments or spread payments over to a sister customer, 3 months or 6 months? That's assuming the supplier is able to handle a delayed payment plan.
It's a very good question. Morning, Richard. I trust you're on the call. It's a very, very good question, because what I'm reading between the lines is a certain degree of concern around the ability of the customer or the debtor to settle over those timeframes that he mentioned. Now, this is a common, and reading through some of the other questions on the chat group as well, people are just as concerned about their debtors as they are about the financial health of their suppliers. Now, again, like I said on the supply chain finance, communication is absolutely critical. You've got to sit down with their customer and understand how severe the predicament is that they are in, because you run a risk that they might not be able to pay their invoice at all. And if that's the case, it could actually mean that your business itself as a supplier is no longer able to operate. The terms in the economy generally in the SME space, around 30-day statement, which equates to about 45 days end to end. Now, an interesting factor to consider as well is that credit insurance is available in the South African market through a number of providers. And what I suspect a lot of people have seen is that they've either seen limits cut on debtors, they've seen endorsements limiting how much will be paid under credit insurance, or they've been unable to obtain cover on certain debtors at all. Now, how do we look at it through a bank lens? What would we recommend in terms of a payment plan? I would say that it depends on how much margin you have in the transaction. Because if you've done a deal, and typically in the trading space, 5 to 7% net profit margin, what you've got to work out is what is the cost of me financing that term extension myself relative to the profitability that I have in the transaction? Because what is the use of doing a deal at a loss? In the fullness of time, that's going to impact your own profitability. It's going to put your own business in jeopardy. But we also understand that these are uncertain times, and people are prioritizing any receipt at all over the fact that the deal might not be profitable, but they need to get the cash back into the business so that they can revolve that cash, buy more stock, sell to a different debtor, and try and keep trading. Generally speaking, shorter is better. The quicker you can get cash into your business, the better. So I would say in Richard's scenario, or the scenario that he painted, is to sit down with that debtor and say, look, if you are able to settle earlier, here is a settlement discount that I'm prepared to offer. And that settlement discount's got to be calculated according to how much profitability there is in the transaction. If he's really worried about his debtor, then he's going to be offering a fairly generous settlement discount so that he can get that debtor to pay as quickly as possible. The question then from our side is, would you continue selling to that debtor? Because that then becomes the next question. And very often what we see in terms of debtors is that most companies will have, especially in the SME space, will have a few key debtors. And it's not an easy decision to make to decide to stop supply. So, Richard, I don't know if there's a way that you can feedback whether that answered your question, but thank you for that question.
Thanks, Mike. Richard, ask us to quickly pop a message in the chat line and let us know if you need any further detail or context on that. We've received another question, which comes from Lulama Muyunda, which, Mike, I think is also aimed at your expertise. Do we have supply chain finance solutions available for SMMEs? Because smaller entities have fewer resources available to help absorb business shocks and usually fall short of qualifying for bank finance solutions.
This is a question that's very close to my heart because SMMEs are the hoped for driving force of this economic recovery. And what often characterizes an SMME is that there's limited balance sheet capacity. I mean, if you've recently started a business, there's only so much capital that you can put in. You've received an order from a corporate, you're trying to grow your business, and without a balance sheet, it's typically very difficult to get hold of a bank overdraft straight out of the gate. There are these days, and thankfully, and especially during COVID, there are mechanisms where liquidity is flowing through the banks to support the economy. In terms of supply chain finance, though, it really is dependent on your buyer's willingness to incept a supply chain finance program. And another question that came through on the chat line that talks to a very similar point is, globally, supply chain finance solutions have been available for a lot longer than in South Africa. And, one of the trends that we've seen since 2015 is that there's a number of fintechs that have come into the South African market with world-leading digital platform capability, where corporate buyers have looked at these platforms and they've opted to move strongly into supply chain finance. And I wouldn't be exaggerating to say that in the last 5 years, growth in the number of supply chain finance programs in this market has been nearly exponential. And it's only a matter of time before you either consider supply chain finance as a solution for your business, or you're invited by one of your corporate buyers to join their supply chain finance program. So I think it's a problem that hopefully over time is going to become less and less, because really it is one of the fastest ways that corporate South Africa can deploy liquidity into its emerging supplier base, which as we've said, in this webinar, is a critical catalyst to help this economy recover from the shocks that it's endured over the last period of time. So I'd also appreciate to know if I answered the question, but yeah, welcome any other questions around these topics.
Thanks, Mike. Just to the audience, before I come back to you, Lloyd, we will get to all of your questions. If not today, between Nedbank CIB and myself, we'll get all your questions answered, and I'll get it back through to you. So Lloyd, over to you. A question for you from Temba Maidi, and I saw Temba did post another question, so we'll try and get to that shortly.
Yeah.
And his question is, having had a horrid time with zero turnover for the year due to zero export, how can I be funded for local trade finance for coal, albeit I am subcontracted to the main supplier?
Okay. Yep. And I saw Temba put a few more on LCs on the question. So I think the first thing is, with local trade, all the same rules applies with international trade. So you can do much of the same thing. So if you have a purchase order locally, then and it really depends now on the risk of the contractor. So as we said in the earlier part of our discussions, the key thing is trade finance can't bridge the gap between pre-delivery. So in other words, we only go on risk on trade finance generally after delivery. So you always have this conundrum of your timing between getting your supplier to supply their end buyer without security, or they want full payment and you're not going to get payment till it's delivered. And I think that's the quandary that Temba's in at the moment. And so there are a couple of things you can do. The first thing is, if you can get some kind of irrevocable payment undertaking from your buyer and you're subcontracting to them, then you take that to the bank and say, can they help fund against it? Or alternatively, are you able to give the same kind of undertaking to your suppliers on the back of the one you have? We call them back-to-backs, and you can back-to-back a lot of things. But that's really what you have to do. And it really, there's a lot of other issues at play that you need to be, it really depends on what your bank relationship is, how long you've been in business, do you have a track record? These things are important. It's not just, if you've been in business 10, 15 years, amazing track record, well known, you'll find it a lot easier to do it. If you're a new startup business, it becomes more difficult. Now, one of Temba's other questions is transferable LC. Now, if you are getting an inward transferable LC as the first recipient, then all your problems are solved, because you can just transfer that LC to your 3 suppliers, okay? And you can transfer it in the percentage of what they are supplying. And then they have LCs, and once they ship or deliver, they get paid under the ledger of credit. So, then that's relatively easy. However, if you are the second recipient, in other words, the contractor got the first inward transferable LC, and they've transferred it to you, you cannot untransfer it. And then the only other option available to you is to do an assignment of proceeds. And I see you mentioned another bank's name there. You need to go to that bank and say, listen, on my inward LC, I'd like you to assign the proceeds of this LC to the following 3 suppliers in this percentage. Then those people know that once they've delivered and you get paid, the bank will ensure that they get their cut of the money. So that can be done that way. And I hope I've answered some of his queries. I know it gets more complicated, but it's at a high level, that's the type of options you have.
Perfect. Thanks, Lloyd. Thank you. Let's have a look at the other questions that have been raised. So a question came through from Michael Burrell saying, what is the smallest size or amount of an invoice that can be discounted?
It's another very good question, tomorrow. On supply chain finance, it can be 5 cents. It really doesn't matter on supply chain finance, because as long as the buyer has accepted payment for that invoice, it can be traded on the platform, any one of the platforms, quite easily. It's a little bit different on the selective invoice discounting side, because there we're looking at assessing the debtor, the debtor's risk profile, because remember, as I said, it's a non-recourse solution. So the bank will actually purchase the rights to repayment under that receivable. And clearly it's got to be an amount that makes sense. Most corporates will only do selective invoice discounting on very large invoices, simply because it's something that will have the highest impact in the shortest space of time. But yeah, it's another good question, because people do, they might invoice, small amounts very regularly, in which case there are other solutions that banks provide. For example, bulk with recourse receivables finance, your conventional invoice discounting that most banks often provide in the market. And there you would upload your ledger, and it would calculate the amount due to you based on all the invoices that form part of that ledger, no matter the size. Yeah.
Perfect. Thanks, Mike. Another question that was raised is, what is your top tip for businesses that care about their suppliers and want to help them through this tough time?
My top tip is to get your suppliers into a supplier workshop. There's some companies that are very good at this. They'll actually host supplier days where they get their suppliers into a room, and here I'm talking to the procurement departments, and they will take the time to listen to the suppliers. There are other companies where they have an annual contract negotiation and they don't see the supplier again until the following contract negotiation a year later. My top tip is rather follow the former approach, because you're gonna discover some very important information when you get your suppliers in a room. You're gonna pick up on themes. You're gonna pick up on pressures. You're gonna find it possible to solve problems before they manifest in catastrophes. If you're only talking to your suppliers once a year, it's not enough. And that would be my top tip, particularly to procurement departments of corporate companies.
Perfect. Seems like sound advice. Thank you, Mike. Another question. Sure, Lloyd.
I saw a question related to this in the comments. It's also important to know that this does, by providing supply chain finance to your suppliers, it doesn't impact the liquidity of the buyer at all. All that happens is what it will do is it does impact the available facilities. So we do have to use some of their facilities, but a lot of the large corporates have facilities they don't use. So in effect, you're using facilities they wouldn't have used to help them pay their suppliers, but there has no liquidity impact for them.
Yeah.
Brilliant. Thank you, Lloyd. Right, then we've got quite a long question here from Nakwanda Shoba. So what Nakwanda is saying is, from my side, what we have realized is that suppliers or service providers have significantly increased their pricing during the lockdown period, more than 30 to 40%, which makes it hard for any procurement to be done currently, as department heads are not willing to sign off on such ridiculous pricing. From Nedbank, what is the reasonable price increase that we should be experiencing during this period?
It's another excellent question, and I'm going to go out on a limb and say it works both ways. The buyer-supplier relationship works both ways. It's always better to try and cement price increase levels into a contract. We love contracts as bankers, but under a contract, it's going to limit the ability of the supplier to through opportunistic price increases, because when you're looking at those types of levels, it's opportunistic price increasing. So it's not only and the department heads are right, because if you accept those prices, it's going to throw out your own costing, which means you in turn are going to push out higher than expected price increases to your customers. And what's the net result of all of that? We've got a high level of inflation feeding through in supply chains in the economy. And we all know the consequences of that on interest rates. It all has a knock-on effect, and everything is interconnected. So there isn't an ideal level of price increase because it depends on what is being sold. It can be that if you're providing a certain commodity, there's a scarcity of that commodity in the economy, and the laws of supply and demand will dictate that price increases will, of necessity, come through higher than expected. So we're not talking about those scenarios. I think the question's talking more to, supplier sees a gap to push through an above average price increase. Again, it depends on the circumstances surrounding that particular supply chain. And again, the solution to that is communication with that supplier. So you'd have to look at it and say, well, do I have an alternative supplier for the same goods or services at a more reasonable price, and choose that supplier? Because again, the competitive forces in the economy in terms of buying and selling boil down to how competitive does your supplier want to be in terms of winning your business. Of course, there's times that a supplier, in a very roundabout way, is trying to say to the debtor that they don't wish to supply them anymore, in which case they would put through a ridiculous price increase with the view to say, well, either the buyers can accept it or we don't have to supply to them anymore. And that also happens. So without more context, that's difficult to answer further, but it definitely sounds like a conversation with that supplier is needed.
Perfect. Mike, thanks so much. I see we have just gone past 12 o'clock. So I'd like to take this opportunity, firstly, to the audience for joining us and for raising your questions. And secondly, Mike and Lloyd, thank you for your time and for sharing your insights. I really do appreciate it. And to the audience, thank you. And to the audience, we'll be having a further presentation next week. I will quickly put it up on the screen for you to see. It will be the playbook for smart finance, and this will be partnered with Workday. That'll be 3rd of September at 11 o'clock. So be sure to go onto the link, cfo.co.za/events, and be sure to register. So once again, thank you to everybody. We really appreciate your participation. Have a great day further.
Have a great day. Bye. Thanks.
Bye.